The Basics of Finance, Chapter 3, Part 1, Bank Regulation. Because of their important role in financial markets, depository institutions are highly regulated and supervised by several federal and state government entities. At the federal level, supervision is undertaken by the Federal Reserve Board, the Office of the Comptroller of the Currencies, and the Federal Deposit Insurance Corporation (FDIC). Banks are insured by the Bank Insurance Fund (BIF), which is administered by the Federal Deposit Insurance Corporation. Federal depository insurance began in the 1930s, and the insurance program is administered by the FDIC. As already noted, the capital structure of banks is a highly leveraged one. That is, the ratio of equity capital to total assets is low, typically less than 8%. Consequently, they are concerned by regulators about potential insolvency resulting from the low level of capital provided by the owner. An additional concern is that the amount of equity capital is even less adequate because of potential liabilities that do not appear on the bank's balance sheet, so-called off-balance sheet obligations, such as letters of credit and obligations on OTC derivatives. This is addressed by regulators via risk-based capital requirements. The international organization that has established guidelines for risk-based capital requirement is the Basel Committee on Banking Supervision. Basel Committee. This committee is made up of banking supervisory authorities from 13 countries. By risk-based, it means that the capital requirement of a bank depends on the various risks to which it is exposed. Non-depository financial institution. Non-depository financial institutions are intermediaries that do not accept deposits but lend funds to consumer and business. Examples of these institutions include consumer loan companies, trust companies, mortgage loan companies, credit consulting agencies, and finance companies. Unlike depository institutions, non-depository financial institutions have been regulated only at the state level in the U.S., but there is a current discussion on increased regulation of these institutions on the national level, especially in the case of failure of large non-depository financial institutions. One such failure was that of CIT Group Inc., a commercial and consumer finance company, which filed for bankruptcy in 2009. Insurance companies. Insurance companies play an important role in an economy in that they are risk bearers or the underwriters of risk for a wide range of insurable events. Moreover, beyond their risk bearer role, insurance companies are major participants in the financial market as investors. To understand why, we will explain the basic economics of the insurance industry as compensation for insurance companies selling protection against the occurrence of future events. They receive one or more payments over the life of the policy. The payment that they receive is called a premium. Between the time that the premium is made by the policyholder to the insurance company and a claim on the insurance company is paid down, if such a claim is made, the insurance company can invest those proceeds in the financial market. The insurance product sold by insurance companies include life insurance. Policies insure against death, with an insurance company paying the beneficiary of the policy in the event of the death of the insured. Life policies can be for pure life insurance coverage, for example, term life insurance, or can have an investment component, for example, cash value life insurance. Health insurance. The risk insured is the cost of medical treatment for the insured. Property and casualty insurance. The risk insured against financial loss resulting from the damage, destruction, or loss to property of the insured property attributable to an identifiable event that is sudden, unexpected, or unusual. The major types of such insurance are a residential property, house and its content, and automobiles. Liability insurance. The risk insured against is litigation, the risk of lawsuit against the insurer resulting from the action by the insurer or others. Disability insurance. This product insures against the inability of an employed person to earn an income in either the insured's own occupation or any occupation. Long-term care insurance. This product provides long-term coverage for custodial care for those no longer able to care for themselves. Structured settlement. These policies provide for fixed guarantee periodic payment over a long period of time, typically resulting from a settlement on a disability or other type of policy. Investment-oriented product. The products have a major investment component. They include a guaranteed investment contract, GIC, and annuity. In the case of a GIC, a life insurance company agrees that upon the payment of a single premium, it will repay that premium plus a predetermined instead rate earned on that premium over the life of the policy. While there are many forms of annuities, they all have two fundamental features: whether the periodic payment begin immediately or are deferred to some future date, and whether the dollar amount is fixed. Example, guaranteed dollar amount or variable depending on the investment performance realized by the insurers. Financial guarantees insurance. The risk insured by this product is the credit risk that the issuer or an insured bank or other financial contract will fail to make timely payment of interest and principal. A bank or other financial obligation that has such a guarantee is said to have an insurance wrap. At one time, a large percentage of bonds issued by municipal governments were insured bonds, as well as asset-backed securities. The leading insurance companies globally in terms of 2008 revenues are Japan Post Holdings in Japan, which have type of insurance is life health. Allianz in Germany, which have type of insurance is property and casualty. Berkshire Hathaway in United States, which have type of insurance is property casualty. Assicurazione generally in Italy, which has type of insurance is life health. AXA in France, which has type of insurance in life is life health. In the United States, the leading companies include Berkshire Hathaway, State Farm Insurance, and MetLife. Investment companies. Investment companies, also known as asset management companies, manage the funds of individual, business, and state and local governments and are compensated for this service by fees that they charge. The fee is tied to the amount that is managed for the client and, in some cases, to the performance of the assets managed. Some asset management companies are subsidiaries of commercial bank, insurance companies, and investment banking companies. The type of account, client, and lines of business of asset management companies include regulated investment companies, exchange-traded funds, hedge funds, separately managed account, pension fund, regulated investment companies. Regulated investment companies, RICs, the financial intermediaries that sell shares to the public and invest those proceeds in a diversified portfolio of securities. Asset management companies are retained to manage the portfolio of RICs. Various U.S. securities laws regulate these entities. There are three types of RICs managed by asset management companies: open-end funds, closed-end funds, and unit investment trust (UITs). Each share so represents a proportional interest in the portfolio of securities managed by the RIC on behalf of its shareholders. Additionally, the value of each share of the portfolio, not necessarily the price, is called the net asset value (NAV) and is computed as follows. NAV is equal to market value of portfolio minus liabilities, then divided by number of shares. For example, suppose that a RIC with 20 million shares outstanding has a portfolio with a market value of $430 million and liabilities of $30 million. The NAV is $413 million minus $30 million, then divided by 20 million and equals to $20. The NAV is determined only at the close of the trading day. Mutual fund in open-end funds commonly referred to simply as mutual fund. The number of fund shares is not fixed. All new investment into the fund are purchased at the NAV, and all redemption, sale of the fund, redeemed from the fund are purchased at the NAV. The total numbers of shares in the fund increase if more investment than withdrawal are made during the day, and vice versa. For example, assume that at the beginning of a day, a mutual fund portfolio is valued at $300 million with no liabilities and 10 million shares outstanding. Thus, the NAV of the fund is $30. Assume that during the trading day, investors deposit $5 million into the fund and withdraw $2 million, and the price of all the securities in the portfolio remain constant. The $3 million net investment into the fund means that 100,000 shares were issued. $3 million divided by $30. After the transaction, there are 10.1 million shares, and the market value of the portfolio is $303 million. Hence, the NAV is $30, unchanged from the prior day. If instead the portfolio's value and the number of shares change, the NAV will change. However, at the end of the day, NAV will be the same regardless of the net share added or redeemed. In the previous example, assume that at the end of the day, the portfolio's value increased to $320 million because new investment and withdrawal are priced at the end of day NAV, which is now $32. The $5 million of new investment will be credited with 5 million divided by 32 equals to 156,250 shares, and the $2 million redeem will reduce the number of shares by 2 million divided by 32 equals to 62,500 shares. Thus, at the end of the day, the fund has 10 million plus 156,250 minus 62,500 equals to 10,093,750 shares, because the portfolio has a total value of $323 million. The end of day NAV is $32 and not impacted by the transaction. Closed-end funds, unlike open-end funds, closed-end funds do not issue additional shares or redeem shares. That is, the number of fund shares is fixed at the number sold at issuance. For example, at the time of the initial public offering, Instead, investors who want to sell their share or investors who want to buy shares must do so in the secondary market where the shares are traded either on an exchange or in the over-the-counter market. Supply and demand in the market in which funds are traded determine the price of the share of a closed-end fund. Hence, the fund share's price can trade below or above the NAV. Shares selling below NAV are said to be trading at a discount, while shares trading above NAV are trading at a premium. Investors who transact in closed-end fund shares must pay a brokerage commission at the time of purchase and at the time of sale. Unit investment trust. There is a third type of RIC called a unit investment trust (UIT). This type of RIC is assembled but not actively managed. A unit investment trust has a finite life and a fixed portfolio of investment. Cost to investor. Investors in RICs bear two types of cost: a shareholder fee, usually called the sale charge, which is a one-time charge, and an annual fund operating expense, usually called the expense ratio, which covers the fund expense. The largest expense component of the expense ratio is the management fee, also called the investment advisory fees, which is an annual fee paid to the asset management company for its services. RICs are available with different investment objectives and investing in different asset classes: stock funds, bond funds, and money market funds. They are passively managed and actively managed funds. Passive funds, more commonly referred to as index funds, are designed to replicate a market index such as the S&P 500 stock index in the case of common stock. In contrast with active funds, the fund advisor attempts to outperform an index and other funds by actively trading the fund portfolio. Exchange-traded funds. As an investment vehicle, open-end funds, example mutual funds, are often criticized for two reasons. First, their shares are priced at and can be transacted only at the end of the day or closing price. Specifically, transactions, for example purchase and sales, cannot be made at intraday price, but only at closing price. Second, while we did not discuss the tax treatment of open-end funds, we note that they are inefficient tax vehicle. This is because withdrawal by some fund shareholders may cause taxable realized capital gains for shareholders who maintain their position. As the result of these two drawbacks of mutual funds, in 1993, a new investment vehicle with many of the same features of mutual funds were introduced into the U.S. financial market: exchange-traded funds (ETFs). This investment vehicle is similar to mutual funds but trades like stock on an exchange. Even though they are open-end funds, ETFs are, in a sense, similar to closed-end funds, which have small premiums or discounts from their NAV. In an ETF, The investment advisor assumes responsibility for maintaining the portfolio such that it replicates the index and the index return accurately. Because supply and demand determine the secondary market price of these shares, the exchange price may deviate slightly from the value of the portfolio and, as the result, may provide some imprecision in pricing. Deviations remain small, however, because arbitrageurs can create or redeem large blocks of shares on any day at NAV, significantly limiting the deviations. Another advantage of ETFs, in addition to being able to transact in ETFs at current price throughout the day, is the flexibility to place limit orders, stop orders, and order to short sell and buy on margin, none of which can be done with open-end funds. With respect to taxation, ETFs overcome the disadvantage of open-end funds, but we will not discuss the advantage here. From 1995 up until 2008, there has been a steady growth in ETF, as we show in Exhibit 3.6. There are ETFs that invest in a broad range of asset classes and new ones being introduced weekly. Hedge funds. The U.S. securities law does not provide a definition of the pool of investment funds run by asset managers that are referred to as hedge funds. These entities, as of this writing, are not regulated. The following is a definition of hedge funds offered by the United Kingdom's Financial Services Authority, the regulatory body of all providers of financial services in that country. The term can also be defined by considering the characteristics most commonly associated with hedge funds. Usually, hedge funds are organized as private investment partnerships or offshore investment corporations. Hedge funds use a wide variety of trading strategies involving position taking in a range of markets. Hedge funds employ an assortment of trading techniques and instruments, often including short selling, derivatives, and leverage. Hedge funds pay performance fees to their manager. Hedge funds have an investor base comprising wealthy individuals and institutions and a relatively high minimum investment limit set at 100,000 US dollars or higher for most funds. This definition helps us to understand several attributes to hedge funds. First and foremost, the word hedge in hedge funds is misleading because it is not a characteristic of hedge funds today. Second, hedge funds use a wide range of trading strategy and techniques in an attempt to not just generate abnormal returns, but rather attempt to generate stellar return regardless of how the market moves. The strategy used by a hedge fund can include one or more of the following. Leverage, which is the use of borrowed funds. Short selling, which is the sale of a financial instrument not owned in anticipation of a decline in that financial instrument price derivatives to great leverage and control risk. Simultaneous buying and selling of related financial instruments to realize a profit from a temporary misalignment of their price. Hedge funds operate in sectors of the financial market, cash market for stock, bonds, and currencies, as well as the derivative market. Third, in evaluating hedge funds, investors are interested in the absolute return generated by the asset manager, not the relative return. Absolute return is simply the return realized rather than relatively returns, which is the difference between the realized return and the return on some benchmark or index, which is quite different from the criterion used when evaluating the performance of an asset manager. Fourth, the management fee structure for hedge funds is a combination of a fixed fee based on the market value of assets managed plus a share of the positive return. The latter is a performance-based compensation referred to as an incentive fee. In the United States, hedge funds are available to accredited investors as defined by the SEC. Accredited investors include individuals with a net worth over $1 million, banks, insurance companies, and registered investment companies. Separately managed accounts. Instead of investing directly in stock or bonds or by means of alternatives such as mutual funds, ETFs, or hedge funds, asset management companies offer individual and institutional investors the opportunity to invest in a separately managed account, also called an individually managed account. In such account, the investment selected by the asset manager are customized to the objective of the investor. Although separately managed accounts offer the customer of an asset management investment vehicle that overcomes all the limitations of RICs, they are more expensive than RIC in terms of the fee charged. Pension funds. A pension plan fund is established for a eventual payment of retirement benefit. A plan sponsor is the entity that established the pension plan. A plan sponsor can be a private business entity on behalf of its employees, called a corporate plan or private plan. A federal, state, and local government on behalf of its employee, called a public plan. A union on behalf of its member, called a Taft-Hartley plan. An individual, called a individually sponsored plan. Two basic and widely used types of pension plans are defined benefit plans and defined contribution plans. In addition, a hybrid type of plan, called a cash balance plan, combines features of both pension plan types. In a defined benefit (DB) plan, the plan sponsor agrees to make specified dollar payments to qualifying employees beginning at retirement and some payment to beneficiaries in case of death before retirement. Effectively, the DP plan pension obligations are a debt obligation of the plan sponsor, and consequently the plan sponsor assumes the risk of having insufficient funds in the plan to satisfy the regular contractual payment that must be made to currently retired employees, as well as those who will retire in the future. A plan sponsor has several options available in deciding who should manage the plan assets. The choices are internal management. The plan sponsors use its own investment staff to manage the plan assets. External management. The plan sponsor engage the services of one or more asset management companies to manage the plan assets. Combination of internal and external management. Some of the plan's assets are managed internally by the plan sponsor, and the balance are managed by one or more asset management companies. Asset manager who manage the asset of defined benefit plans receive compensation in the form of a management fee. There is federal legislation that regulates pension plan. The Employee Retirement Income Security Act of 1974 ERISA responsibility for administering ERISE is delegated to the Department of Labor and the Internal Revenue Service. ERISE established fiduciary standard for pension fund trustee, manager, or advisor. In a defined contribution DC plan, the plan sponsor is responsible only for making specified contribution into the plan on behalf of qualifying participants, with the amount that it must contribute often being either a percentage of the employee's salary and or a percentage of the employer's profit. The plan sponsor does not guarantee any specific amount at retirement. The amount that the employee receives at retirement is not guaranteed, but instead depends on the growth, therefore performance, of the plan assets. The plan sponsor does offer the plan participant various options as to the investment vehicle in which they may invest. Defined contribution pension plan come in several legal forms. 401 plans, money purchase pension plans, and employee stock ownership plans, ESOPs. A hybrid pension plan is a combination of a defined benefit and defined contribution plan, with the most common type being a cash balance plan. This plan defines future pension benefit, not employer contribution. Retirement benefits are based on a fixed amount annual employer contribution and a guaranteed minimum annual investment return. Each participant's account in a cash balance plan is credited with a dollar amount that resembles an employer contribution and is generally determined as a percentage of pay. Each participant account is also credited with interest linked to some fixed or variable index, such as the Consumer Price Index (CPI). Typically, a cash balance plan provides benefit in the form of a lump sum distribution, such as an annuity. Investment banks. As with commercial banks, investment banks are highly leveraged entities that play important roles in both the primary and secondary market. Investment banking activities include raising funds through public offering and private placement of securities, trading of securities, merger, acquisition, and financial restructuring advising, merchant banking, security finance, and prime brokerage services. The first role is assisting in the raising of funds by corporations, U.S. government agencies, state and local governments, and foreign entities, sovereign and corporations. The second role is assisting investors who wish to invest funds by acting as broker or dealer in secondary market transactions. We can classify investment banking into two categories. 1. Companies affiliated with large commercial bank holding companies. Example of bank holding companies referred to as Bank Affiliate Investment Bank, the Bank of America Securities, a subsidiaries of Bank of America. JP Morgan Securities, a subsidiary of JP Morgan Chase. The second category of investment banks, referred to as independent investment banks, is a shrinking group. As of mid-2008, this group includes Greenhill and Company and Houlihan Lokey, Howard and Zukin. Another way of classifying investment banking companies is based on the type of activities, example, the line of business in which they participate, full-service investment banks and boutique investment banks. The former are active in a wide range of investment banking activities, while the latter specialize in a limited number of those activities. In assisting entities in the raising of funds in the public market, investment bankers perform one or more of the following three functions: advising the issuer on the terms and the timing of the offering, underwriting, distributing the issue to the public. In their advisory role, investment bankers may be required to design a security structure that is more appealing to investors than currently available financial instruments. The underwriting function involves the way in which the investment bank agrees to place the newly issued securities in the market on behalf of the issuer. The fee earned by the investment banking company from underwriting is the difference between the price it paid to the issuer for the security and the price it reoffers the security to the public, called the reoffering price. This difference is referred to as the gross spread. There are two types in underwriting arrangement: firm commitment and best effort. In a firm commitment arrangement, the investment bank purchases the newly issued security from the issuer at a fixed price and then sells the security to the public at the reoffering price. In the best effort underwriting arrangement, the investment banking firm does not buy the newly issued security from the issuer. Instead, it agrees only to use its expertise to sell the security to the public and earn the gross spread on only what it can sell. Typically, in a firm commitment underwriting, there will be several investment banks involved because the capital commitment that must be made and the potential loss of the company capital if the newly issued security cannot be sold to the public at a higher price than the purchase price. This is done by forming a group of companies to underwrite the issue, referred to as an underwriting syndicate, by the lead underwriter or underwriters. The gross spread is then divided among the lead underwriters and the other companies in the underwriting syndicate. The distribution function is critical to both the issuer and the investment bank. To realize the gross spread, the entire security issue must be sold to the public at the planned reoffering price then, depending on the size of the issue, may require a great deal of marketing effort. The members of the underwriting syndicate will sell the newly issued security to their investor client base. To increase the potential investor base, the lead underwriters will often put together a selling group. This group includes the underwriting syndicate plus other companies not in the syndicate with the gross spread then divided among the lead underwriters, members of the underwriting syndicate, and members of the selling group.